Are you looking to maximize the amount of passive income that you receive from certain companies? Well, the good news is that in today's video, you'll discover 3 of the best Canadian dividend stocks that are currently quite undervalued and that are all offering over 6% of dividend to their shareholders every single year. So without further ado, let's take a look at my pick number 1. The first Canadian company that I currently have on my watch list at the moment is the Bank of Nova Scotia with the ticker BNS. With a market cap that exceeds $70 billion, this company is a member of the Big 5 Canadian banks alongside RBC, TD, BMO, and CIBC. However, compared to its main competitors, this bank has been seeing a massive decrease of their total valuation since their all-time high in March 2022, where we can notice that the stock's value has been plummeting by over 30% since that time. This downtrend has been caused by multiple factors, but the most important one by far is the multiple and aggressive hikes of the interest rates by the BOC since 2022. Usually, the banks are the big winners when it comes to rising interest rates because they can increase their total interest net margin. However, over the past 18 months, we've seen that the central banks have been quite aggressively increasing the interest rates, which has caused quite a lot of distress for the investors. In fact, this series of events could have some negative impact on these types of financial institutions, since we could see that their loans default could potentially increase massively. Indeed, by trying to cool down the overall economy by increasing the cost of borrowing, the Bank of Canada has been negatively impacting the view that many investors have towards the economy that could fall off a cliff rather than navigate a soft landing. But in fact, this worrying trend that we've seen with the global economy isn't only impacting the Bank of Nova Scotia. Indeed, it is also impacting many different people around the country, as well as different businesses that are now forced to cut some of their staff, while households are struggling with higher living costs and surging loan payments, which could represent quite some negative news for this type of bank. Knowing that the large portion of the income that this bank is generating comes from the interest arbitrage, which is simply the difference between the interest that they are able to generate from the loans that they are giving to different businesses and particulars, with the difference of the interest that they have on the loans that they are currently paying. Well, if different people and businesses are no longer able to pay their loans, it will obviously make them lose a ton of money. It is why, just like their peers, BNS over the past couple of quarters have been adjusting and increasing their provision for credit losses to address all of these troubled accounts. But the positive news is that this amount doesn't represent an important share of their total portfolio value. Add to this, in their more recent earnings report, we've seen that BNS has also been able to outperform the analyst predictions in terms of the EPS and in terms of their total revenue. Plus, at the moment, the company is currently trading with a super cheap price to earnings ratio of less than 10 with excellent profit margins. Add with an excellent 6% plus dividend that is paid on a quarterly basis with a great dividend payout ratio, which is showing that the dividend is sustainable on the long term. All of these factors make that I believe that the worst is currently behind them and that they could see some potential great growth for the next couple of years. Second on my list, I've decided to go with the energy company Enbridge with the ticker ENB. If you're looking for a company that is distributing over 8% of dividend income to their shareholders, Enbridge could be a particularly interesting pick for you. Over the past couple of months and years, we've seen that Enbridge has been another victim of the high interest rates, where we can see that the stock's value is down by close to 10% since 1 year. Indeed, with an impressive debt that accounts for about $80 billion and that also represents about 128% of debt to equity ratio, this could rapidly become a real problem for many investors in the long term. However, the more positive news for the investors is that that with a DCF payout ratio of 65%, their massive 8% dividend yield that has been increasing for a 29th consecutive year could continue to grow at the same speed for the next couple of years. Another important event that has impacted the value of Enbridge lately came at the end of last year, where we've seen that the company has acquired 3 natural gas utilities from Dominion Energy for about $14 billion. This kind of represents a great news for the investors, which is showing that the company is continuing to expand the scope of the operations around North America. But in fact, the problem came in terms of how the company has purchased this deal. This financing came in the form of new issuance of $4.6 billion of new shares from Enbridge. And so in the short term, by issuing new shares, this can dilute the value of the existing shares that the investors were having. But from a brighter note, on an investor point of view, with the recent implication of Iran in the current war, combined with the OPEC decision to voluntarily cut the oil production to make sure to stabilize the oil price, this has made the price of the barrel skyrocket since the last couple of weeks, and this has also helped Enbridge to regain some great momentum lately. Plus, during their latest earnings report, we've seen that this TSX Goliath has been reporting some great results with some growth year over year of about 6% in their net EBITDA, and with a super low price to FFO ratio of less than 9 at the moment, this could represent a potential great buying opportunity on the long term for many investors. Finally, for the last pick on my list, I've went in a sector that has been struggling quite a lot over the past 5 years, which is the telecommunication sector, and so I've decided to include the company Bell with the ticker BCE. I've long hesitated between Bell and TELUS to include on this list, but when we see that Bell is currently by far the most undervalued telecom company on the market right now, well, this has been quite a no-brainer to include this company that has been down by close to 30% since the beginning of the year. Add to this, for all the dividend income investors, this company is currently offering close to 9% of quarterly dividend to their shareholders. But just like for the other companies on my list, the biggest problem with Bell comes from the super high interest rate environment that we currently have. Indeed, this company has been slapped in the face with their super high debt of $35 billion with a super high debt to equity ratio of over 175%. The big problem with it is that they are currently paying quite a lot more interest payments compared to what they were paying a few years ago. This makes that despite slight growth in their net operating revenue combined with impressive growth in their free cash flow over the past quarter, we've seen that their net earnings have been fallen by 23% year over year in their more recent earnings report. When we know that the dividends of a certain company is paid directly from the net earnings of a certain company, this important decrease of their net earnings have been quite importantly increasing their dividend payout ratio that is now over 170%. This is simply illustrating the fact that the company might be forced to slightly cut their dividends in the near future to be able to continue to pay them in the long term. This type of ratio is sending a quite negative signal to the investors that the company doesn't have enough earnings to pay the dividends at the moment, and so it means that at the moment the company is forced to finance a certain part of the dividends that they are giving to their shareholders every single quarter, and so it means that in the long term they'll have a lot of interest payment to do with the super high interest rates that we are currently seeing on the market. All of these bad news have made that the company was forced to cut over 9% of their total workforce in March. Add to this, the company has also issued a statement that they wanted to decrease their total capital expenditures of $1 billion between 2024 and 2025. This was mainly justified by the recent news of the CRTC that wants to increase the choice and affordability of high-speed internet services across the country, which will all come down to a massive price war between all the important actors in the telecommunication market in Canada. But despite all of these bad news, Bell is operating in a field that is often considered as a triopoly in Canada that is divided between Bell, Rogers, and TELUS. This means that Bell is still an important actor in this growing Canadian telecom market that is expected to continue to grow over the next couple of years with the project immigration. And personally, from an investor point of view, I see these recent news with a pretty good eye because it means that they will be able to reduce quite importantly their total expenses. And so it means that the company is trying to financially get back on track, which means that they could see some potential growth in their net earnings over the next couple of quarters. Add to this, while many experts are expecting that the interest rates could slowly start to go down over the next couple of months, it means that a company like Bell could see a pretty good potential of upside from this news, where they could see their total interest payments be cut. Nevertheless, at the moment, I am still holding to my BCE shares because they are still able to provide a massive 8% plus of dividend to their shareholders every single quarter. And in their next earnings results, if I see some great financial results, I might be tempted to add a few shares to my own portfolio. So there you have it. Those are 3 of the best Canadian dividend stocks that are currently available on the stock market and that are currently trading at discount right now. Don't fool yourself. Dividend income is an important factor of the equation, but it isn't all, because you should also focus on the total growth of your investment. But on your side, if you want to discover how much money should you have invest in the stock market to retire comfortably off your dividend income, well, check out the video that's gonna be right over here, and I will see you soon. Peace.